Australia's unemployment rate printing at 4.5% in April, the highest since the pandemic, should have been simple bad news. Instead, it triggered a repricing that left mortgage holders better off and the ASX higher by the end of the session, which is a result the headline number alone cannot explain. The mechanism is the RBA's reaction function. NAB shifted its final hike call from June to August, with senior economist Taylor Nugent stating directly that the balance of risks has shifted. The labor market is no longer giving the board cover to keep pressing. Westpac's call for a June pause moved from probable to high conviction. ANZ and Commonwealth Bank do not expect any further hikes this cycle at all. That is 4 of the big 5 banks repricing the rate path in the same direction within hours of a single data release. The capital flow read from this is not that investors bought the labor market weakness. They bought the removal of a known selling pressure. The rate hike premium embedded in Australian bank shares and rate-sensitive property trusts had been a persistent drag. The positioning unwind was the flow, not enthusiasm for a slowing economy. From the perspective of leveraged institutional holders of rate-sensitive domestic equities, the position pressure that justified the defensive stance was removed by one data point, and the repricing was immediate. What the pause does not resolve is the inflation question. Westpac still expects further hikes in August and September if the energy price shock passes through to consumer prices as expected. NAB's delay is conditional, not a rate cut call. The RBA's own language acknowledges space to monitor, but monitoring is not easing. The 4.5% unemployment print gave the board permission to wait, not permission to declare the cycle over. That distinction is why the repricing was sharp on the day but thin in duration, and why the next inflation print due before the August meeting carries more weight than this week's labor data.
The RBA pause freed rate-sensitive capital from a defensive stance, but it did not answer where that capital was meant to go. Guzman y Gomez answered part of that question for domestic growth equity holders on the same day. GYG's decision to exit the U.S. market, closing all 8 Chicago restaurants with immediate effect, produced a share price move of 15 to 20% intraday, peaking at $21.80 before settling closer to $19.84. The direction of the move is what the analysis requires, not just its size. Markets typically punish companies that write down international expansions. The U.S. exit came with a one-off cost of $30 to $40 million on the FY26 result, yet the share price surged. That divergence signals that the U.S. drag had already been priced deeper into the stock than the cost of exit justifies, and that institutional holders were not waiting for the write-down to materialize before repositioning. The specific capital flow, short seller positioning, and underweight institutional exposure unwound into the announcement. GYG's Australian segment EBITDA guidance was simultaneously upgraded to approximately $85 million for FY26, representing 29% growth on the prior year, with 32 new restaurant openings still on track. That combination, cost removal plus earnings upgrade in the core business, gave institutional re-entry a valuation anchor, not just a sentiment one. Foreign net selling that had accumulated during the U.S. expansion period rotated into domestic institutional buying on the session. The deeper issue this raises is whether the GYG repricing is idiosyncratic or symptomatic. The ASX 200 closed at a 5-day high, led by resources and select NCWR names. The broader market's performance suggested the rate pause created a floor under risk appetite, but GYG's move was structurally different. It was a capital reallocation into a specific domestic asset, where the forward earnings trajectory had just improved in measurable terms. Rate pause beneficiaries re-rate generically. Earnings upgrade beneficiaries re-rate with a specific fundamental anchor. That distinction matters for what the repricing can sustain, and it also raises a question the budget has not yet answered, whether the domestic capital pool available for equity reallocation is itself about to contract.
The rate pause and the GYG repricing both imply a domestic capital rotation into quality equities. The budget has installed a structural constraint on the pool of capital that rotation can draw from, and the banking sector's response this week is the clearest evidence that the constraint is real and immediate. Westpac and Macquarie moved within days of the federal budget to stop factoring negative gearing into their investor lending assessments for existing property purchases. Neither institution waited for the policy to take formal legislative effect. The lending policy change precedes the law because responsible lending obligations require banks to model borrower capacity against the rules that will govern the loan's life, and from July 2027, negative gearing on existing homes is gone. Capital Brief confirmed the operational instruction had already been issued to lenders internally. That is not a market sentiment signal. It is a structural reduction in the leverage capacity of a specific holder class, property investors, enforced through the credit channel, not through asset prices. The CGT chain compounds the constraint from a different direction. From July 2027, Australia replaces the 50% discount with cost-based indexation and a 30% minimum tax on real capital gains. For any taxpayer below the 47% marginal rate, the new floor exceeds the headline CGT rate of the United States, the United Kingdom, Germany, Italy, and over 25 other jurisdictions. Junior mining explorers reliant on retail investor flows have already flagged that the change will reduce the capital available for early-stage equity risk. The property investor class and the retail equity risk taker face simultaneous leverage compression and tax floor compression, two independent channels removing capital from the pool that Australian asset markets have historically drawn on. The allocation implication is not that domestic equities fall, it is that the capital rotation identified in the GYG session, out of leveraged property, into quality domestic growth equity with self-funded earnings, is likely to be a smaller pool rotating faster rather than a large structural inflow. AFR's $375 million institutional placement, cornerstoned by Gina Reinhardt's Hancock Prospecting at $85 million, drew from institutional and sovereign-backed funding lines, the German Raw Materials Fund, Export Finance Australia, the National Reconstruction Fund, not from retail or leveraged property investor capital. That is the segment of the capital market where the budget's constraint does not yet bite. The monitoring variable for the next 48 hours is whether the June RBA meeting statement signals the board's residual inflation vigilance has softened, or whether the energy price transmission still holds the hike threat intact, because that determines whether the rate pause capital frayed this week stays in domestic equities or retreats into cash while waiting for the budget's full structural impact to become measurable. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.